So how can strategic equity help you handle some of this uncertainty and the certain volatility that we're going to see inside the stock market? There's one thing you have to understand. Strategic equity's been around for 20 years. We've seen stock prices go up, we've seen stock prices go down. We already talked about two examples where the Fed was unable to stop a bear market and a recession. We've lived through that. We've managed money through that, and we've come out stronger on the other side because of that risk management. Something that's really important in your portfolio is to deal with how it is positioned. Too many people for too many years have been focusing on, you got to buy and hold stocks for the long run. That's left a lot of people exposed to the stock market when they really couldn't afford it. I recently was looking at what they call the target funds, and now they have these for target retirement, but they also have them for 529 plans. And I have 6 kids, and I was just astonished with how these target funds were invested. And what really blew me away was my son, who's a junior in high school, and is going to be needing start tapping his college fund in 3 years. Based on his high school graduation date, this fund family's target fund had 30% of his portfolio invested in stocks. Now there's one thing we know based on history. Just before and during a recession, which we know that we're obviously going to have another recession probably in the next 7 years before he graduates from college, the market goes down on average 40%. So if you have 30% of your money in these target funds invested in an asset class that could lose 40%, that's already a 12% hit to his college fund. That's something we can't afford. So it's really important to look at your investment period, meet with your financial advisor, and focus first. Do I have a budget? Do I have my insurance needs taken care of? Have I paid down my debt? And then start filling down your pyramid. You need to take care of your short-term needs. Some people have such a low risk tolerance that they may have all their money in short and mid-term type investments. Very few people should have a significant amount of their money invested in the stock market. And that's something where a good financial planner can really help you. That's the key driver to getting through these uncertain times. But there's a couple other things that strategic equity does. Number one is we use mechanical systems that are engineered to try to get rid of all the noise, all this fundamental stuff we were talking about. We want systems that just look at the data inside the market and invest according to what the probabilities say are either gains in the market or losses in the market. There's a lot of times where these statistics coming out of the market say, based on historical data, this is a risky time to invest, so our systems by design will tell us to get out. They don't care what Ben Bernanke does. They don't care what's happening in Europe. They just want to look at the raw data coming out of the market. Another way that strategic equity can help our clients is by removing the emotion from their portfolios. There's a company called Dalbar that studies investor behavior, and I've always found these studies fascinating. And this has been true whether it was the 1990s tech bubble, the real estate bubble, or where we're at today, is most investors do not achieve the gains that mutual funds state because what do? When the market goes up a bunch, they decide, you know what, I should buy more of XYZ fund. But then when it starts to go down, like we saw the 50% drop in 2008, most people end up selling. So they don't get to enjoy the 9% return the S&P 500 had. Instead, the average growth investor has only earned 3.8% going back the last 20 years. They call that the irrational behavior gap, and that's something, having our mechanical system, having you fill out that pyramid from the top down and not having too much money exposed to areas of the market that you can't afford to be exposed to allows you to miss behaving irrationally. The other thing that we're really trying to do with strategic equity is to keep the losses as low as possible. Now, there's something they call the mathematics of losses, and that's illustrated on this chart. And you have to understand, when you lose money, you have that much less money to make it back up on the upside. So one of the things the easiest example to understand is if you lose half your portfolio value, you don't have to make 50% to get back to break even. You have to double your money, which is a 100% return off the bottom. And the other thing I notice in this chart is there's a point where it starts to curve up so high that the losses that you get become more and more costly in terms of how much risk you have to take to make the money back. So by using our mechanical approach, we try to keep those losses in a range that can be made up easily with average market returns. There is, however, a problem with active management, and this is something that those of you that have been around active management may understand, is that I guarantee you active management will not keep up with the S&P 500. I also guarantee you that a lot of people want to compare whatever they're invested in to the S&P 500. Now, it's important to understand the reason we can't keep up with the S&P 500, and the only way you can, is if you invest in the S&P 500 the entire time period, which means you're going to own all the gains, but you're also going to own all the losses. So a big mistake that people make with active management is to compare our returns to the S&P 500. Now, we pulled out our most popular fund. It's most popular because most of our clients tend to be age 50 and older. So when you imagine that investment pyramid, they tend to be near the top of that. So they have a lot of short-term money. They also have a lot of money that they don't want to take a lot of risks on. This is our income allocator program going back to 1998, which is the year I started with Strategic Equity. And I find it interesting that 9 of the 14 years I've been with Strategic Equity, we've underperformed the S&P 500. I'm proud of that. And you might say, well, why would you be proud of underperforming more often than you outperform? I'm proud of it because if you look at the bottom, the total return of 191% versus that 67% number for the S&P 500, that shows that we did our job. Our job is not to capture all of the upside in the market. Our job is to keep the losses at a level where you're not going to be shooting yourself in the foot. You're not going to be acting irrationally because you lost so much money. So while it may be frustrating when the S&P 500 beats whatever it is we're doing, the real value in active management comes during those uncertain times like we're probably facing. When we deal with the fiscal cliff, when we deal with the debt problems, when we deal with whatever's going to happen again in Europe. That's where we add our value. Now I want to close today by gaining a little perspective on where we're at. Again, we just talked about the last 14 years for the stock market. And there's something that people don't understand. The market has gone up to around 1,500 on the S&P 500, and then it lost half its value. Then it went up again, around 1,500, and then it lost half its value. Now it's been climbing back up again. And the issue I have is that for 14 years, the market's been going through this cycle. They call that a secular bear market. Now, I don't know if this cycle is going to continue, but what I do know is, as we showed from all those charts, the stock market basically tracks economic growth. All the things that our economy is facing tells us that the stock market is not going to be able to grow because the economy is not going to be able to grow. Now, we're getting to a point where we're 5 or 6% away from that 1,500 level again. That could be the point where everybody begins to realize. That might be when the fiscal cliff finally starts hitting the front pages. That's when investors might start to panic because they don't know what their taxes are going to be. Likely we're going to see businesses stop spending money in the latter half of this year until this whole situation is resolved. We've sort of set the recipe for huge declines in the market once again. Now, I hope I'm wrong. I hope that somehow both sides come together and we fix it. We come up with a budget solution and things can keep going. That'd be great because we're actually right now, as Peter likes to say, we're at the party. we have money invested in both our bond programs and our stock programs. We're pretty heavily invested right now. The difference is we have systems that are looking to get out at any time. At signs of danger, these things are designed to start stepping out of the market. Now, they're not going to be perfect. They're going to endure some losses, of course, when the market first starts going down. But the key, if you think back to that mathematics of losses, is we need to minimize those losses as much as possible, because there's going to be opportunities on the other side, and that's what we're trying to play